Hi everyone, happy Friday Money Wind Up. Well, should you wait for prices to drop or buy now? With interest rates rising another 0.25% this week, buyers are asking the same question again. Should I wait for property prices to fall or buy now before things get worse? It's understandable. Higher rates affect borrowing power, monthly repayments and buyer confidence. And every time rates rise, headlines start predicting property downturns. But property decisions are rarely that simple because while interest rates matter, they're only one part of the larger picture. So what does a 0.25% rise actually mean? 0.25% increase might not sound huge, but it impacts affordability more than people realise. For borrowers, it can mean higher monthly repayments, reduced borrowing capacity, tighter household budgets, and more caution from buyers. For example, on a $700,000 loan, 0.25% increase could add roughly $100 to $120 a month in repayments, depending on the loan structure and your term and your interest rate that you've currently got. That's enough to make some buyers pause, and when buyers pause, markets can slow. So will property prices drop? Possibly in some areas, but not always dramatically and not evenly. Property markets don't move as one single market. Some suburbs may soften while others continue growing due to low housing supply, population growth, rental shortages, infrastructure investment and strong owner-occupier demand. And we are seeing that everywhere at the moment. What we're seeing right now is more of a market reset in many areas, not necessarily a crash. So higher interest rates tend to cool momentum rather than completely collapsing demand. The problem with waiting for prices to fall, and most buyers miss this catch, is even if property prices soften slightly, higher interest rates may wipe out the benefit. So, for example, if you buy now on an $800,000 property at 6%, the estimated outcome is your higher purchase price. Wait for a 5% drop, the property price is now $760,000, but the interest rate is 6.5%. Lower price, higher repayments. In many cases, buyers discover they can actually borrow less once interest rates rise further. So while the property might become cheaper, financing it becomes harder. So borrowing capacity is the real story. This is the part buyers should pay attention to. As rates rise, banks reduce borrowing limits. Serviceability becomes tougher and some buyers are priced out altogether. A buyer approved for $850,000 6 months ago may now only qualify for $780,000 or less. That changes purchasing options significantly. So waiting doesn't always improve affordability. Sometimes it reduces your ability to compete altogether. And meanwhile, rents keep rising. So one of the biggest drivers keeping buyers active right now is rental pressure. Across many parts of Australia, vacancy rates remain extremely low, rents continue increasing, and competition for rentals is intense. Once upon a time, you went to an open home to purchase a house. Now you go to an open home to rent it. It's crazy. For some buyers, the monthly gap between renting and owning has narrowed considerably, and it's pushing many people to buy despite higher rates, especially if they're planning to stay long term. Timing the market's still a bit risky. A lot of people believe, I'll just wait until the market bottoms out. Reality? You only know the bottom after it's passed. I've been in this industry for over 20 years. I've yet to see the market bottom out. Once confidence returns, buyers re-enter really quickly. Competition rises, prices stabilise, and growth often resumes faster than expected. So historically, buyers who wait for certainty often end up paying more later. When waiting does make sense, to be fair, buying now isn't automatically the right move for everyone. Waiting may be smarter if repayments would stretch your finances too far, or if you don't have a savings buffer, your employment situation's uncertain, you're relying on maximum borrowing capacity, you're hoping rates fall to improve affordability, There's a difference between being cautious and being paralysed. A rushed purchase under financial pressure can create far bigger problems than waiting 6 to 12 months. The bigger picture, the long-term strategy, people who typically build wealth through property aren't the ones who perfectly time interest rate cycles. They're usually the ones who bought quality property, managed repayments responsibly, held property long-term, allowed time and market growth to work in their favour. Interest rates will rise and fall over time. But long-term ownership tends to matter more than short-term market noise. So some final thoughts. The latest 0.25% rate rise will absolutely impact buyer sentiment. Some buyers will wait, some markets will slow further, and borrowing power will tighten again. But the perfect buying window rarely feels obvious in real time. If your finances are stable, your repayments are manageable, and you're buying with a long-term plan, waiting purely for headlines to improve may not necessarily put you ahead. The smarter approach is usually less about predicting the market, more about understanding your own financial position, risk tolerance, and long-term goals. So guys, have a great weekend. Happy Friday Money Wind Up.